Company shares represent ownership in a company. When you buy shares, you own a small piece of that company, giving you certain rights and a stake in its success. Companies issue shares to raise money for operations, growth, or new projects, and in return, shareholders get a claim on the company's assets and profits. There are two main types of shares: common shares and preferred shares. Common shares are the most widely held and give you voting rights, typically one vote per share, allowing you to influence decisions like electing the board of directors. They also provide dividends, which are a share of the company's profits if declared. However, common shareholders are last in line to get paid if the company goes bankrupt. Preferred shares, on the other hand, usually don't come with voting rights but have fixed dividends and get priority over common shareholders in case of liquidation. Let's break it down with an example. Imagine a company decides to issue 1 million shares, and you buy 1,000 shares at $10 each. You've invested $10,000 and now own 0.1% of the company. If the company's profits grow, its stock price might rise. For example, if the share price increases to $15, your 1,000 shares would now be worth $15,000, a $5,000 gain. On top of that, if the company declares a dividend of $1 per share, you'll receive $1,000 in dividend payments. Shares are traded in stock markets like the New York Stock Exchange, NYSE, or NASDAQ, where buyers and sellers determine the price based on demand and supply. The value of a share depends on factors like the company's financial health, market conditions, and investor sentiment. For instance, positive news about the company, such as strong earnings, can drive up the share price, while negative events might cause it to drop. Owning shares also means taking on risks and rewards. The reward is the potential for capital gains, when the share price increases, and dividends. The risk is that the share price could fall, or the company might perform poorly, reducing the value of your investment. In the worst-case scenario, if the company goes bankrupt, shareholders might lose their entire investment. Shares are a critical part of wealth building. Many investors buy shares to grow their money over time, as stocks have historically provided higher returns compared to other investments like bonds or savings accounts. For example, long-term investors who own shares in successful companies like Apple, Amazon, or Microsoft have seen their investments grow significantly over the years. Another benefit of owning shares is diversification. By investing in shares of different companies, sectors, or countries, you can spread out your risk. For instance, if you own shares in both tech companies and energy companies, poor performance in one sector may be offset by gains in the other. However, investing in shares requires understanding and patience. Share prices can be volatile, moving up and down based on market conditions. For beginners, it's important to research companies, understand their financials, and consider long-term potential rather than short-term price movements.